Hello, and welcome to Mayor Brown's webinar on Intragroup financing, Post-BEPS, and the Tax Cuts and Jobs Act. I'm Scott Stewart, a partner in Mayor Brown's Chicago office and a member of the tax controversy and transfer pricing practice. I represent taxpayers at all levels of federal tax controversy, including audits, administrative appeals before the Internal Revenue Service, mediation involving the Appeals Division of the IRS, and litigation before the United States Tax Court. Joining me today as co-presenters are partner Astrid Pirone and Director of Transfer Pricing and Valuation Services, Elena Kripanova. Astrid leads the Mayor Brown European Transfer Pricing Center that coordinates transfer pricing strategies and controversies in Europe. Her practice covers counseling on the transactional aspects of transfer pricing, tax optimization of mergers and acquisitions, structuring of investment funds, and general assistance to private equity deals. Elena has 20 years of transfer pricing, valuation, and general quantitative analysis experience. She has performed transfer pricing and valuation analyses for purposes of advanced pricing agreements, tax planning, contemporaneous documentation, audit defense, and litigation for clients that range from some of the largest multinational enterprises in the world to privately held companies in a wide range of industries. Before we begin, we'd like to mention a few housekeeping announcements. First, as noted under the FAQ widget on the right side of your screen, today's program is being streamed through your computer, so there is no dial-in number. For the best audio quality, please make sure your computer speakers or headset are turned on and the volume is up so you can hear the presentation. You may submit questions during the webinar. If your questions are not answered during the webinar, we will respond to any unanswered questions via email. Lastly, regarding CLE credit, we will be providing an alphanumeric code during the presentation. In order to receive CLE credit, participants must record this code on the virtual sign-in sheet that was emailed to you with the login instructions for today's program. These forms are also available to download on the right-hand side of your screen under Resource List if you need them. With that said, let's get started. In the not-too-distant past, issues related to intercompany debt were largely a matter of application of U.S. case law. A number of recent developments have changed the landscape, including BEPS Actions 8 to 10 on aligning transfer pricing with value creation, BEPS Action 4 on interest deductions, the issuance of proposed regulations under Section 385 in 2016, the Tax Cuts and Jobs Act in 2017, including changes to Sections 163J and the enactment of the Base Erosion and Anti-Abuse Tax, or BEAT, the backlash against the 385-2 regulations leading to their revocation in 2018, and the OECD discussion draft on financial transactions, also in 2018. Our webinar considers first the accurate delineation of financial transactions. Next, we examine the U.S. and European perspectives on debt and equity. Then we look at the pricing of intercompany debt and limits on the deductibility of interest. We also look at intercompany financial guarantees, and finally we touch briefly on cash pooling transactions.
Let us start with a review of the OECD guidance on accurate delineation of a transaction. The discussion draft on financial transactions consists of two parts. Part 1 deals with the accurate delineation analysis under Chapter 1 and how it applies to the capital structure of an entity within a multinational group. Part 2 reviews specific issues related to the pricing of various financial transactions. The draft starts by emphasizing that financial transactions between related parties, including the prices charged and the ultimate profit reported as a result of the transaction, can differ from transactions between unrelated parties because the capital structure of a borrowing entity that is part of a multinational group differs from that which would exist if it were an independent entity operating under the same or similar circumstance. The draft specifically relies on commentary to Article 9 of the OECD Model Tax Convention, which says that Article 9 is relevant not only in determining whether the rate of interest is an arm's length rate, but also whether a prima facie loan can be regarded as a loan or should be regarded as some other kind of payment, in particular a contribution to equity capital. This statement highlights the fact that in the current post-BEPS environment, taxpayers should be concerned not only with the pricing of a related party financial transaction, but also whether the transaction will be respected as structured by the relevant tax administrations. The draft explicitly states that accurate delineation of the actual transaction under Chapter 1 will precede any pricing attempt, and therefore, whether the transaction is ultimately regarded as debt or equity will be determined separately from and prior to the issue of pricing the transaction. So how do we use Chapter 1 to accurately delineate the actual financial transaction? First, we analyze the factors that affect the performance of businesses in the industry sector in which the multinational group operates. Then we develop an understanding of how the particular multinational group responds to these identified factors. The factors at the level of industry and multinational group will define the market and industry environment within which a multinational group operates and will affect both the quantum and pricing of a transaction. Then, once we understand the macro environment at the level of industry and multinational group, we take a more granular look at the transaction itself. Specifically, we identify the economically relevant characteristics of the transaction, including its contractual terms, the functions performed, assets used, and risks assumed by the parties, and the characteristics of the financial product or services under review. The discussion draft elaborates that to accurately delineate an advance of funds, several factors should be considered, including the presence or absence of a fixed repayment date, the right to enforce payment of principal and interest, and the ability of the recipient of the fund to obtain loans from unrelated lending institutions. As we will see later in this presentation, many of these factors resonate with domestic rules in various jurisdictions, including those in the United States. There is, however, language in the draft that sets the draft apart from the previous approaches. The draft states in particular that the accurate delineated amount for transfer pricing purposes would be a function of the maximum amount that the lender is willing to lend and the maximum amount that the unrelated borrower would be willing to borrow. This language appears to be setting up a different approach from the typical approaches to analyzing financial transactions by considering here both sides to the transaction. As you recall from the previous slide, most of the characteristics of the transaction had to do with the borrower, not with the lender. The draft further raises a question whether the entire amount needs to be accurately delineated as equity in the event that either of the maximum that would be loaned or maximum that would be borrowed is less than the total funding required for a particular investment. The language seems particularly onerous here because the draft does not specify which party, or perhaps even a tax authority, will have the task of determining the amount of the funding required, which raises the possibility that at least a portion of the taxpayer's loan may be characterized because the tax administration might disagree with the taxpayer as to the amount of the required funding. The discussion draft goes further by emphasizing that options realistically available should be considered from the perspective of each of the parties to the transaction. It is not immediately apparent how the options realistically available will be factored into the accurate delineation of the transaction. For example, whether the lender's realistic alternative to deploy funds into other investment opportunities with a different rate of return, or the borrower's option not to borrow in order to avoid placing negative pressure on its credit rating, will cause the related party transaction to be recharacterized in whole or in part if the tax authority views these options as preferable.
As confirmed by the OECD Transfer Pricing Guidelines update in July 2017, intercompany agreements provide a starting point for delineating the transaction, and attention should be paid to the drafting of these agreements, as well as to their consistency with the actual conduct of the parties. There should also be consistency between the intercompany agreements and the transfer pricing documentation, the master file and local files. If no written terms exist, the tax authorities will rely on their analysis of the conduct of the parties to identify the transaction.
Importantly, however, the guidance in the draft clarifies that the draft is not intended to prevent countries from addressing capital structure and interest deductibility under domestic legislation, and that it does not seek to mandate accurate delineation under Chapter 1 as the only approach for determining whether purported debt should be respected as debt. In other words, countries can decide for themselves how to address capital structure and interest deductibility of the entities in their jurisdiction. For intercompany debt, the preliminary question for any tax administration is whether there is a bona fide debt. This question will depend on a variety of factors in multiple bodies of law. Many of those factors, including the relative ability to repay the debt, will also affect the pricing of that debt. Let's now take a look at how domestic legislation might be different from Chapter 1 analysis.
First, let's take a look at the U.S. perspective on debt and equity. For decades in the United States, the distinction between debt and equity was governed mostly by a large body of case law that attempted to distinguish between debt and equity based largely on multi-factor tests. The court sought to determine whether the instruments involved more closely fit the classic definition of debt or the classic definition of equity. Put simply, debt is an unconditional obligation to repay a sum certain with interest in a reasonable time. Equity is entrepreneurial capital at the risk of the business. While the tax law has its own definitions of debt and equity, at least in the simplest cases, these definitions are similar to the common financial understanding of debt and equity. The Second Circuit in Gilbert versus Commissioner stated that a debt is an unqualified obligation to pay a sum certain at a reasonably close fixed maturity date, along with a fixed percentage in interest payable regardless of the debtor's income. The Third Circuit in Finhay Realty stated that equity is risk capital entirely subject to the portions of the corporate venture. Common factors from the debt equity case law used to distinguish debt from equity include the following. An unconditional promise to pay a sum certain at a fixed date in the foreseeable future is an indicator of debt. Credit-like rights to enforce payment, such as foreclosure in the event of default, also indicate debt. If rights are subordinate to general creditors, this is an indication of equity. The right to participate in management is also an indication of equity. Thin capitalization also indicates equity. Identity of interest between debt holders and stockholders is sometimes cited as an indicia of equity, but this factor may not be too important, as courts have sometimes held that the same entity can be both a debt holder and a stockholder. Labels placed on the instrument can be important as well, although the labels are clearly within the control of the parties. Whether an instrument is intended to be treated as debt or equity for non-tax purposes may be another important factor. While it is not an absolute requirement, it is generally best to be consistent between tax and non-tax treatment of a particular instrument. The IRS was often not satisfied with the results that it attained in debt equity cases under the common law factors. This led to the promulgation of the Section 385 regulations in 2016. As originally promulgated, the Section 385 regulations would have, among other things, imposed strict documentation requirements. Corporate taxpayers and associations such as the Organization for International Investment, or OFI, which represents a number of large foreign taxpayers doing business in the U.S., reacted strongly to the proposed documentation regulations. Executive Order 13789 was issued by the Trump administration in April 2017. The order required the Secretary of the Treasury to review all significant tax regulations issued after January 1, 2016, to alleviate the burden of regulations that impose an undue financial burden on U.S. taxpayers or add undue complexity to the federal tax laws. Notice 2017-36 delayed the effective date of the documentation regulations to January 1, 2019. In September 2018, the IRS proposed to withdraw the documentation regulations, and taxpayers were permitted to treat the documentation regulations as withdrawn. While a detailed discussion of the Section 385 regulations is beyond the scope of this webinar, it's important to have a general understanding of the provisions. Section 385-1 largely contains definitions. Regulation 385-2, as discussed on the previous slide, contained detailed documentation requirements that have not been adopted. As will be discussed on the next slide, however, taxpayers may still want to adhere to some of the documentation requirements of 385-2 in order to demonstrate compliance with the common law factors establishing debt. Prior to the promulgation of Regulation 385-3, taxpayers would sometimes issue debt to a related party by paying a dividend of a note to a related party. Such dividends of notes often did not involve the receipt of cash by the issuer of the note. These types of transactions were permitted by the common law. Section 385-3 establishes that such transactions are no longer valid. Using a complex set of rules, Section 385-3 also invalidates other transactions deemed to have a similar effect. Generally, Regulation 385-4 relaxes the rules of Section 385-3 for entities that are members of a consolidated U.S. group by treating the members of the U.S. consolidated group as one corporation. As mentioned on the prior slide, while the formal documentation requirements of Section 385-2 are not in force, these requirements overlap to a significant degree with the factors recognized under the common law test. Therefore, taxpayers may be well advised to follow the documentation rules of Regulation 385-2, at least in part, in order to establish bona fide debt under the common law principles. In particular, taxpayers may wish to establish a documented ability to repay the debt, the existence of a written agreement, some creditors' rights, and post-issuance conduct consistent with a debt instrument, such as regular payment of interest. We will look at these factors in more detail in the next few slides. Of the factors listed on the prior slide, demonstrated ability to repay is certainly one of the most important. Historically, taxpayers would seek to establish ability to repay by targeting a certain debt-equity ratio, such as 2-to-1. Recent case law establishes that a reasonable target debt-equity ratio standing alone may not be sufficient to establish bona fide debt. Rather, at least where the amount at stake is large, taxpayers are well advised to demonstrate adequate cash flow to pay interest and repay at least a portion of the principal of the debt. Regarding repayment of debt, taxpayers have often asserted that it was appropriate to repay debt by refinancing at least a portion of the principal. The IRS took the opposite view, asserting that refinancing of principal was not consistent with bona fide debt. Consistent with common commercial practice, courts have recognized that refinancing of principal may be consistent with bona fide debt. Another potentially important factor in establishing bona fide debt is a written debt instrument. While courts have recognized bona fide debt in the absence of a written debt instrument, best practice is to document loans in writing, particularly where the amount involved is large. Another significant factor in establishing bona fide debt is the presence of creditors' rights. The IRS sometimes takes the view that the creditor's rights found in a related party transaction should precisely mirror the rights found between third parties. This proposition is highly debatable, since creditors' rights often serve as a mechanism to convey information from the borrower to the lender. The importance of this informational function is diminished in the related party context, since presumably the lender is knowledgeable regarding the financial condition of the related borrower. Nevertheless, related parties should consider including certain covenants in their debt instruments, such as the right to accelerate debt in the event of default, limits on total indebtedness, covenants to limit disposal of key assets, covenants to maintain liquidity, and covenants to maintain financial ratios indicating profitability. Another important factor in establishing bona fide debt is the behavior of the parties. Characterization of bona fide debt is typically established at the time that the debt is put in place. However, the IRS may assert that debt should be recharacterized as equity in instances where the IRS believes that subsequent behavior does not reflect a debtor-creditor relationship. In cases where interest payments are routinely late or unpaid, the IRS may assert that the debt should be recharacterized as equity. A variation on this theme of non-payment is the IRS's so-called circular interest position, as reflected in the Laidlaw Holdings case. In Laidlaw, the borrower made timely interest payments, but the interest paid was immediately re-lent to the borrower using a so-called dividend reinvestment loan. The IRS asserted that these circular interest payments should be ignored, and the court agreed with the IRS. The IRS continues to pursue debt equity issues on audit. Generally, the IRS's position may take one of two forms. First, the IRS may seek to disallow a portion of the taxpayer's interest deductions by asserting that the interest rate charged is too high and should be reduced to an arm's length rate. Alternatively, the IRS may assert that the taxpayer has more debt than is reasonable and seek to recharacterize the debt as equity. A position closely related to this one is that the interest rate between the parties is too low, and when the interest rate is increased to an arm's length rate, the debt is not supportable. In cases where the IRS seeks to convert debt to equity rather than simply reduce the interest rate, a question arises whether all of the debt at issue should be treated as equity or only a portion. For this reason, it may be advisable to issue intercompany debt using multiple notes or tranches in order to facilitate an argument that only a portion of the debt should be disallowed should that become necessary. Another important factor to consider in establishing bona fide debt is the borrower's debt capacity. The 385-2 regulations would have required a debt capacity analysis. While no longer a requirement, a debt capacity analysis may still be best practice, particularly where the amount of the debt is large. A debt capacity analysis may take several forms. One form is an in-house analysis of certain financial ratios, such as debt equity, total debt to EBITDA, and interest coverage ratios. Another form of analysis includes detailed cash flow projections over the term of the loan to demonstrate that the debt can be serviced and ultimately repaid. Another form of analysis is a shadow bond rating, which is intended to replicate the types of analysis undertaken by a rating agency such as Standard & Poor's. These types of analyses can be performed either in-house or by a third-party service provider such as a ratings agency.
In Europe, we do not have a uniform definition of interest, debt, or equity. Generally speaking, common law and civil law countries have their own domestic definition, what provide the basis for hybrid instruments, being instruments regarded as debt in one country and equity in another country, providing for deductible interest in one country and tax-exempt dividends or deferred taxation in the other country. A typical example is the profit participating loan. In line with the conclusion of the BEPS Action 2 report, the legislation of the European Union aims at neutralizing the tax benefits of the hybrid instruments through a series of tools, the EU tax avoidance package. The package includes amendments to the parent subsidiary directive to avoid exemption when there is a deduction in the source country, and to directives called ATAD 1 and ATAD 2, providing for a denial of deduction or obligatory inclusion of certain hybrid instruments. We also note that recharacterization for tax purposes is not the favored approach by European tax authorities, specifically those from civil law countries. They much prefer interest limitation rules such as debt-equity ratio or fixed ratio rules. They are court cases, of course, and we can observe that in the Netherlands, for example, shame loans, bottomless pit loans, and PPLs, profit participating loans, have been treated as equity. In the UK, interest on bonus shares, some convertible securities, results-dependent securities have been recharacterized as non-deductible distribution. As an example of the recent evolution in Europe, Luxembourg revised its legislation on different fields. Regarding hybrids, which are a popular way of financing Luxembourg companies, they are now adopting the ATAD 2 directive, tackling hybrid arrangement with non-EU countries, and this may be the end of the well-known CPEX. They also revised their guidance for intercompany financing, requiring more substance in Luxembourg and also focusing on equity at risk. When there is equity at risk, one favor arm's length remuneration will be a mere return on equity. When there is no equity at risk, the arm's length remuneration should be just a limited service fee.
Next, we turn to the pricing of intercompany debt. The discussion of the appropriate compensation for the provision of funds between related parties goes back to the BEPS Actions 8 through 10, which propose to substantially limit returns for providing capital or funding without more. For example, entities that provide funding without exercising any control over the financial risk of providing funding, that is so-called pure cash boxes, are treated as not assuming any risk at all and are therefore entitled only to a risk-free return. The situation that resembles a pure cash box is presented in box B6 of the discussion draft. In that case, there is a funded party, the funder, which is entitled to no more than a risk-free rate of return under the guidance of Chapter 1, and a different related party exercising control over the risk, which is entitled to the residual interest from the transaction. If a party exercises control over the financial risk associated with the provision of funding, that party would generally expect a risk-adjusted return on its funding. Once we determine that based on the analysis of risk and control, the funder is entitled to more than the risk-free rate of return, then additional factors need to be considered in order to determine the risk-adjusted return at arm's length. We mentioned earlier that the perspectives of lender and borrower are taken into account when determining the volume of funds to advance. Both perspectives are also considered in pricing of intercompany debt. We also need to figure out, in pricing the transaction, a common ground on which to base the analysis. When funds are advanced between unrelated parties, the starting point to determining the pricing often rests with the borrower's credit rating. The credit rating, when performed correctly, will encompass and reflect the various factors that determine the relative ability of an entity to meet its financial commitments and the likelihood of investors receiving the money owed to them in accordance with the terms on which they were invested. The difficulty in the analysis of intercompany debt is that related party borrowers are seldom rated by the rating agencies, which thereby puts the onus on taxpayers and transfer pricing analysts to come up with a rating. The draft puts forth for discussion two rebuttable presumptions. The first one is a rebuttable presumption that an independently derived credit rating at the group level may be taken as the credit rating for each group member. The second rebuttable presumption is that tax administrations may consider to use the credit rating of a multinational group as a starting point from which appropriate adjustments are then made to determine the credit rating of the borrower. the ultimate adoption, in the consensus document, of either of the rebuttable presumptions will have a significant effect on related party financial transactions, both quantum and pricing, because of the link between the credit ratings and the various financial ratios that have to be met to maintain a given rating. The discussion draft also devotes significant space to the discussion of passive association and implicit support. The draft states that in pricing an intragroup loan, the borrower is viewed as an independent enterprise. This does not mean, however, that the presence of the rest of the group is necessarily ignored. Therefore, the potential impact of passive association on creditworthiness and other terms of being part of the group should be taken into account. The discussion draft provides several potential methods for pricing of intercompany debt. The most straightforward is the cup method, which, according to the draft, is easier to apply to financial transactions than to other types of transactions because of the active markets for borrowing and lending money and the frequency of such transactions between independent borrowers and lenders. Most of the cups are likely to be external cups. The draft states that it is unlikely that a multinational group's average interest rate paid on its external debt meets the comparability requirements to be considered as an internal cup. If comparable loans cannot be found, then arm's-length interest rates can be also based on the return of realistic alternative transactions with comparable economic characteristics, for example, bond issuance. Another proposed method is the cost of funds, which considers the cost of funds incurred by the lender in raising the funds to lend, plus the expenses of arranging and servicing the loan, a risk premium to reflect the various economic factors inherent in the proposed loan, plus a profit margin. This method seems to be rather subjective because, according to the discussion draft, the cost under this method should consider the lender's cost of funds not in isolation, but relative to other lenders operating in the market. Finally, the draft mentions the bank opinion as the potential method, but largely dismisses it as providing sufficient evidence of arm's-length terms and conditions.
In the United States, generally the arm's-length standard applies to the determination of an interest rate on an intercompany loan. More on that on the next slide. A couple of exceptions to the arm's-length standard are important. First, the situs rule. The situs rule addresses funds obtained at the situs of the borrower. If the loan or advance represents the proceeds of a loan obtained by the lender at the situs of the borrower, the arm's length rate is equal to the rate actually paid by the lender, increased by an amount which reflects the costs or deductions incurred by the lender in borrowing such amounts and making such loans, unless the taxpayer establishes a more appropriate rate. Second is the safe harbor interest rate. The safe harbor is a range of rates based on the applicable federal rate, or AFR. The appropriate AFR to use in a particular situation varies based on the term of the loan at issue. The safe harbor is a range of rates from a lower limit of 100% of the applicable federal rate to an upper limit of 130% of the applicable federal rate. The safe harbor is unavailable if the intercompany lender is regularly engaged in the trade or business of making loans or advances to unrelated parties, or the loan is denominated in a foreign currency. Notably, no safe harbor is proposed in the OECD discussion draft. As mentioned on the prior slide, the general rule in the United States is that an arm's length interest rate applies. There are several possible sources of arm's length interest rates. First, bond yields observable in the marketplace based on an appropriate debt rating. Second, interest rates available to the lender. Third, interest rates available to the borrower on a standalone basis. Additional factors to be considered in determining an arm's length interest rate include the creditworthiness of the borrower, which may be determined using a shadow bond rating, the principal amount of the loan, the duration of the loan, and the security involved.
Next, we consider the deductibility of interest expense. In October of 2015, the OECD published BEPS Action 4 on limiting base erosion involving interest deductions and other financial payments. The impetus for Action 4 was the recognition by the OECD that multinational groups may achieve favorable tax results by adjusting the amount of debt in a group entity through intra-group financing, and that financial instruments can also be used to make payments which are economically equivalent to interest but have a different legal form, thereby escaping restrictions on the deductibility of interest. To address these risks, Action 4 called for recommendations regarding best practices in the design of rules to prevent base erosion through the use of interest expense. The arm's length test, such as the multi-factor tests used by U.S. courts, were considered not sufficient. While the OECD recognizes the advantage of an arm's length test in being able to accommodate the different level of expenses related parties might have depending on their circumstances, the OECD also noted several problem areas, including lack of effectiveness against profit shifting because intragroup debt can be structured with equity-like features to justify interest payments significantly in excess of those the group actually incurs on its third-party debt. In other words, there needed to be a mechanism to restrict the deductibility of interest to prevent base erosion. To this effect, the October 2015 Action 4 proposed three approaches. One is the fixed ratio rule, which limits borrowers' interest expense to a statutory benchmark ratio between 10 and 30% of EBITDA. As we will see shortly, this is similar in concept to the new Section 163J. Second is the group ratio rule, which allows an entity to deduct net interest expense up to its group's net interest EBITDA ratio, where this is higher than the benchmark fixed ratio. And finally, there is targeted rules, where the OECD members are encouraged to develop rules targeted at particular transactions giving rise to base erosion and profit shifting concerns not resolved by fixed ratio and group ratio rules.
In the United States, the Tax Cuts and Jobs Act made changes that affect the deductibility of interest. First, the Tax Cuts and Jobs Act modified Section 163J. In broad terms, prior to TCJA, Section 163J limited interest deductions to 50% of EBITDA. This was a generous limitation when compared to similar limits in other countries and, practically speaking, had little impact. After TCJA, the limits are stricter. Generally speaking, for years prior to 2022, the limit on deductibility of interest is 30% of EBITDA. For years after 2021, the limit is 30% of EBIT, the distinction there being between EBITDA and EBIT. Disallowed interest can be carried forward indefinitely. The Tax Cuts and Jobs Act also enacted the Base Erosion and Anti-Abuse Tax, or BEAT. While a detailed discussion of BEAT is beyond the scope of this presentation, it's safe to say that interest paid to a related party was one area of concern in enacting BEAT. Speaking very broadly, in order for the BEAT to apply, the taxpayer must meet two tests. First, the taxpayer's average annual gross receipts must exceed $500 million. Second, the taxpayer's base erosion percentage must exceed 3%, or 2% in the case of financial institutions. The base erosion percentage is determined by dividing the base erosion tax benefits by all deductions of the taxpayer. While there are exceptions, broadly speaking, the base erosion tax benefits include an amount paid to a related foreign party that is deductible for U.S. tax purposes. Based on this very general description, it's easy to see that a taxpayer could readily exceed the 3% threshold. In essence, the BEAT functions as an alternative minimum tax. The taxpayer pays the BEAT if its tax liability under BEAT exceeds its ordinary tax liability. Broadly speaking, the BEAT tax rate is applied to the taxpayer's modified taxable income, which is the corporation's taxable income after adding back deductible cross-border payments to affiliates. The BEAT tax rate was 5% for 2018, is 10% for 2019 to 2025, and 12.5% for years after 2025. Higher rates apply to financial institutions.
As a preliminary remark, the EU implemented BEPS Action 4, which promotes financing through equity rather than debt. But there is also another incentive, which is to finance through equity in the proposed Common Consolidated Corporate Tax Base, the CCCTB. Indeed, the proposed directive provides for a single set of rules to calculate companies' taxable profit in the EU, and it includes a notional interest deduction compute on the equity base. Coming back to the implementation of BEPS Action 4 in the European Union, the limitation of interest deduction to 30% of the company's EBITDA is provided by ATAD 1. The first anti-tax avoidance directive also covers other anti-tax avoidance measures, such as the General Anti-Abuse Rule or the Rule on Hybrid Mismatches. The goal of the directive is to ensure a coordinated implementation of the OECD best practice recommendation. The EU member states had to implement the directive before December 31, 2018. But this is not a uniform implementation across the European Union. The member states indeed have options. They may implement additional provisions, being a de minimis threshold of €3 million, an exclusion for standalone entities, group ratio rules also with an alternative rule for groups, carry forward of carry back of excess interest expense. If the standard implementation deadline was December 31, 2018, the EU member states evidencing that they have national rules that satisfy the equally effective standard may postpone the implementation of the EU rule till 2024. 5 member states were recognized as having such national rule. In addition, Ireland and Austria also claim to have such national rules, but last month they received from the EU Commission a formal notice for demanding implementation of the EU rules. At this stage, 21 member states applied the EU fixed ratio, but they also implemented different options, such as the carry forward and carry back option. France and Belgium, for example, have different rules regarding carry forward or carry back. That can result in potential double taxation, and it requires careful analysis.
Let's now take a look at intercompany guarantees. We start by reiterating the OECD position that in pricing an intragroup loan, the borrower is viewed as an independent enterprise. This does not mean, however, that the presence of the rest of the group is necessarily ignored. In other words, while a subsidiary is viewed as an independent enterprise, it is not always evaluated on a standalone basis. The OECD acknowledges that there are benefits to a subsidiary from being part of a larger multinational group, but these benefits are not necessarily compensable. Non-compensable are incidental benefits attributable solely to an entity being part of a larger multinational group. On the other hand, the benefits are compensable where they arise because of deliberate concerted group actions. The consideration for both compensable and non-compensable benefits is important because both proportions are taken into account in pricing of a guarantee. The OECD mentions several factors in determining the presence of implicit support, including the likelihood that support will be provided by group members. The likelihood depends on the relative importance of the entity to the group as a whole and the linkages between it and the rest of the group, either in its current form or in terms of future strategy. It also depends on the likely consequences for other parts of a multinational group of supporting or not supporting the borrower. In pricing an explicit guarantee, the starting position of the borrower is that with an implicit support, however large or small it might be. The OECD defines a financial guarantee as a legally binding commitment on the part of the guarantor to assume a specified obligation of the guaranteed debtor if the debtor defaults on that obligation. However, the effect of a financial guarantee is broader than simply allowing the borrower to borrow a certain amount. Effects of a financial guarantee can be to permit a borrower to borrow a greater amount of debt than it could in the absence of the guarantee. It could allow the borrower to reduce the cost of the debt funding or to have an effect on other terms and conditions of the loan, depending on facts and circumstances. Therefore, in order to accurately delineate the transaction, one has to evaluate exactly what effects a particular guarantee had on the underlying transaction, that is, whether the borrower was able to borrow a larger amount at a lower rate, with fewer covenants, or all of the above. Upon answering these questions, another question emerges. If the amount that would have been borrowed without a guarantee is lower than the amount actually borrowed with a guarantee, then what amount of debt would be respected? The OECD suggested that in these circumstances, a portion of the loan from the lender to the borrower can be accurately delineated as a loan from the lender to the guarantor, followed by an equity contribution from the guarantor to the borrower, thereby paving the way for wide discretion on the part of tax administrations on how to characterize the transaction. There are two seminal court cases on the topic of intercompany lending and guarantees that are a must-read for anyone interested in the subject. We cannot do justice to these cases during the couple minutes we can devote to them, but we also would be remiss not to mention these cases because of their importance to the future analysis of intercompany financial transactions. The first case is the General Electric Capital Canada, decided in 2009. While the issue under consideration in this case was the deduction of guarantee fees by GE Capital Canada as paid to GE Capital US during 1996 through 2000 tax years, the case touched upon several important and related topics, including whether a standalone credit rating is a proper analytical approach, or whether implicit support should be considered. Because, see, if we believe that central issue in transfer pricing is how the parties would have arranged their transaction if they had been dealing at arm's length, then all distortions that arise from the parties' relationship must be eliminated to arrive at an arm's length result. That includes implicit support. The second case is Chevron Australia Holdings, decided in 2015. At issue in this case were interest payments made by Chevron Australia Holdings to its U.S. subsidiary under an intercompany loan arrangement during tax years 2004 through 2008. Just as in GE Canada case, Chevron Australia case concerned the interpretation of the arm's length principle in the context of financing, Article 9, and specifically whether the potential for credit support by parent or affiliate entities in the absence of legally binding guarantees should be considered under the arm's length principle. GE Canada was decided for the taxpayer. Chevron Australia was decided for the respondent. Both cases will leave a lasting mark on the adjudication of future cases involving intercompany financing.
What is the U.S. perspective on guarantees? Parental support of a subsidiary can take a number of forms, some stronger and some weaker than others. Possibly the weakest is implicit support, in which the potential benefit of passive association with a corporate family is taken into account. Next is letters of awareness, in which the parent states that it is aware of a transaction between a subsidiary and a third party. Next are comfort letters, in which the parent states that it has no present intention to reorganize its corporate group. Another form of support is the Keep Well agreement, in which the parent promises to provide a specified amount of funds to the subsidiary in order to allow the subsidiary to meet its obligations. Most important and the strongest form of support is the formal guarantee, in which the parent guarantees the financial performance of the subsidiary. Parental guarantees and the fees associated with parental guarantees have been the subject of disputes between the taxpayer and the IRS. The services regulations of Section 42-9 do not directly address financial guarantees. By analogy, however, the regulations might be read to imply that no fee is required to compensate for implicit support, while an arm's length fee should be paid for a formal guarantee.
There is no specific EU guideline regarding guarantees. It should be noted that guarantee costs are included in the definition of interest and borrowing costs, subject to the limitation under ATAD 1. There are also recent court cases in this field, such as the 2018 decision of the Court of Justice of the European Union in the Hornbach-Baumark case. In this case, this German case relates to the issue of comfort letters free of charge by the German headquarters to allow the granting of bank loans to Dutch subsidiaries showing negative equity. According to German rules, a guarantee which provides an access to capital market should be remunerated based upon arm's length principle. The German tax authorities consequently imposed an income adjustment. The case escalates to the Court of Justice of the European Union that state or conclude that in casu there was justified commercial reasons for the granting free of charge of the comfort letters. Other court cases, such as in Belgium, relate to the deductibility of the costs associated to the granting of guarantees. In the Netherlands, there is an important 2013 court decision called the Umbrella Credit Judgment, disallowing costs related to shareholder motives. Two decisions taken in May 2019 make use of it in the context of intragroup guarantees. The first relates to a national cash pooling arrangement where all participants assume joint and several liability for all claims that a bank might have against any other participant. The court concluded that the cross guarantees were reflecting shareholder-related motives and not business motives. Consequently, the credit losses incurred by the two Dutch taxpayers were not tax deductible. In another case regarding a guarantee provided by the parent company to a subsidiary in respect of a bank loan, the court did not qualify it as a shareholder motive, but refers to the arm's length principle, reference to the conduct of a comparable independent entity.
Next, let's take a look at the pricing of intercompany guarantees. The OECD discussion draft outlines a number of methods that could be used to price a guarantee. One seemingly straightforward method is the comparable uncontrolled price, or CUP method, which looks to the prices charged in similar third-party transactions. In practice, however, the circumstances involved in the controlled and uncontrolled transactions will rarely be similar enough to apply this method. Another method is the yield approach. The yield approach looks to the reduction in interest rate obtained by the borrower as a result of the guarantee. For example, if a subsidiary borrower has a standalone debt rating of BBB but receives a guarantee from its parent with a AA rating, the yield approach measures the value of the guarantee by looking to the difference in interest rates between AA rated debt and BBB rated debt. Another approach is the cost approach. The cost approach works on the premise that financial guarantees are equivalent to another financial instrument and prices the guarantee accordingly. For example, the guarantee might be treated as a put option and priced using an option pricing model, such as the Black-Scholes model. Another approach is the valuation of expected loss approach. The valuation of expected loss method estimates the value of a guarantee by looking to the probability of default and the expected recovery rate in the event of default. For example, for a bond with a given credit rating, Standard & Poor's publishes data on the probability of default and the likely recovery given default. This data can be used to determine the value of a guarantee on the underlying obligation. Another method is the capital support method. The capital support method may be suitable where the difference between the guarantor and the borrower's risk profiles could be addressed by introducing more capital to the borrower's balance sheet. It would be first necessary to determine the credit rating for the borrower without the guarantee, but with implicit support, and then to identify the amount of additional notional capital required to bring the borrower up to the credit rating of the guarantor. The guarantee could then be priced based on an expected return on this amount of capital. Unlike the OECD, the U.S. has been slow to address financial guarantees. Treasury has indicated that it intends to issue transfer pricing guidance on intercompany guarantees, but little guidance has been issued so far. One preliminary question is whether the guarantees should be examined under the services regulations or under some other paradigm. The preamble to the services regulations provides that no inference was intended that financial transactions, including guarantees, would otherwise be considered the provision of services for transfer pricing purposes. It is unclear what regulations would be applied to price a guarantee, if not the services regulations. Practically speaking, however, a determination of which set of transfer pricing regulations apply to determine the value of the guarantee may have less to do with the arm's length charge than with collateral effects such as sourcing of income. Treasury has made clear that the services cost method, which is a simplified transfer pricing method applicable to low-value services, may not be applied to financial guarantees. Presumably, this is because a financial guarantee is deemed to provide more than nominal value. As mentioned on the prior slide, Treasury has been slow to provide guidance on the pricing of guarantees. Theoretically, the CUT or CUSP, Comparable Uncontrolled Services Price method, would seem to be attractive methods to price guarantees, but these methods are difficult to apply in practice. In the absence of further guidance, taxpayers are left to use their best judgment regarding, first, whether a charge is required based on a particular set of facts, and, if so, how to determine the arm's length charge. In 2012, the American Bar Association's section of taxation submitted to Treasury extensive comments and recommendations on transfer pricing related to guarantees. The ABA comments discuss a number of methods that might be used to price guarantees, and the methods discussed in the ABA comments overlap to a significant degree with the OECD's pricing methods discussed a few minutes ago. While neither the OECD guidelines nor the ABA comments is authoritative, they provide potentially useful insight in the absence of authoritative guidance from Treasury.
The OECD discussion draft was asking for contribution on a series of financial transactions, including on cash pooling. The OECD received more than 1,000 pages of comments and is now working to find common ground. One of the open questions is the accurate delineation of cash pooling transactions. The discussion draft refers to situations where it would be correct to treat them as something other than a short-term cash pool balance, such as a longer-term deposit or a term loan. The discussion draft acknowledges the practical difficulties of the subject and does not provide any guidance at this stage. Regarding pricing for the cash pooling leader service, the draft makes a general assumption, vigorously challenged by business contributors, that the cash pooling leader performs nothing else than a coordination function with a limited remuneration. In our views, the remuneration should always depend on the functional analysis and specifically the allocation of risk. The draft considers different options to be evaluated for rewarding the cash pool members. It is enhancing the interest rate for all participants, applying the same interest rate for all participants, or allocating the cash pooling benefits to the depositors. As you may see, there are still a lot of work to be done.
As we've seen, recent developments introduced by the OECD's BEPS initiative and its discussion draft on financial transactions, new regulations under U.S. Code Section 385, the U.S. Tax Cuts and Jobs Act, and evolving rules in Europe have led to a marked increase in complexity related to intercompany financial transactions. We hope you found this webinar to be a useful overview of the subject. Thank you for your participation, and have a good day.